What's up, everyone, and welcome to one of the most important videos that you could possibly watch and even thinking that you could adopt when it comes to appropriately understanding value. If you understand what I'm about to walk you through, you will be an empowered investor, an empowered seller, which means that you're going to be one of those individuals that multiplies their wealth instead of gets rid of their wealth. This single understanding, comprehending this reality, I think is one of the single most important realities that you can understand when you're buying, selling, investing in real estate. And that is how you actually understand and determine market value range. This right here is one of the easiest ways to explain it. It's just a simple picture with a box and two lines. And the reason why I'm going to do this, really show you this range, is because despite what anyone may tell you, whether that be a Redfin or a Zillow or et cetera, no one knows what exact market value is. We have guesstimates, we have zestimates. We can do our best to see where the market is, where the market has been, and really more importantly, where the market is going. So take care, lest you think that Zillow gives you the exact value of your home or even an appraiser. These are guesstimates. The only reality, the only thing that knows what true market value is the market. Now, I know that may sound like a circular argument, and well, it is. But the market determines what the market value is. And I think in this case, for this illustration, what I think would be best is just to understand that this right here, this middle range, is what a property's value is. And what I want to show you now is there are four methods of pricing properties or understanding how properties are priced, and they have different consequences. One of the most important things to understand when you're looking at a range like this is days on market. That's another video. It's probably one of the most important levers that you can understand and pull, but we'll leave that video for now and understand that days on market is important, and we'll go over that in just a little bit, but we need to know what that is. So here is method one. This over here would be high bound, meaning high price. And then this over here would be low bound, meaning low price. Let's say that you're a seller and that you want to get the most amount of money for your home. And so you price it high because in your mind, you think that if you price it high, somebody comes in slightly lower, you have some negotiating room. Well, what can tend to happen when prices are priced way over here on this high bound is that they sit on the market. And let's just say that the average days on market is 21 days on market. And let's say in this example, you've got a home here that is currently on the market. Current days on market is 42. And when you have a property that is on the market for this long, here's what actually happens is that this property, we'll just call this property one. Property one sits on the market, and then people reduce the price, and then they keep adjusting the price, and then they keep adjusting the price to try and now chase the market on the back end. And unfortunately, what that ends up doing usually is that it pushes value all the way here to below market value. And because the property sat on the market, it becomes stale. And when it becomes stale, people think there's a deal. And when there's a deal, you actually end up selling the property for less than what the market value really is. But because you priced it wrong, now you're having to deal with that consequence. It's not the best method, but it is a method. Let's now say that you've got another home, and instead of wanting to overprice, what you want to do is price really, really low. So we'll say this is home two, and you price it extremely, extremely below market. And let's say you've got 10 offers, or actually scratch that. Let's say you get up to 30 offers, because when you price it this low, it really induces a feeding frenzy on this home. You get tons of showings, you get tons of offers. But because you priced it low, you have this psychological barrier that we all have, that people don't want to overpay for a property. And so when you price it low and there's such a huge delta to overcome in order to get there, what you also end up seeing happen is you have on a too low price property, you end up here and you're still priced below market. One of the most important things that you can understand in this whole thing is that this is really a graph of human emotion. When you look at the stock market is a graph of human emotion. You have FOMO, you have all these different things. But what you have to understand is psychology and neuroscience. When you understand that, you know how to actually price a property. And in this example, when you price it too low and people now have to be in a multiple offer scenario, you're going to have a delta. You're going to have a ceiling, rather, of how much people are really willing to pay. And in this case, pattern typically is that you see people pay more than what you came to market for, but you're still really below true market value because you priced it too low. Now, let's say you've got method 3 and method 4. These are the last two remaining methods that you have. And in method 3, what you're going to do is we're really just going to price it right around here. I messed up. Don't want to draw this line here. We're going to price it right around here, right above what you see market value being. And let's say in this case, you still have an average 21 days on market is the average days on market that it takes a property to sell. You price a property right here above market. You know that you've got about 3 weeks, 21 days to get offers. And so you patiently await, believing that you priced it just above. And when you price a property just above here, you tend on getting a contract price that's really just above or just at market value. And so you really maximize the possible return that you could get. And so you price it right here. That's option 3. Really, method 4 is what you do is you price a property. Sorry, I drew this too far. You price a property here just below market value, not at market value, but just below market value. Maybe you do this because you want a quicker sale. Maybe you do this because you want more attractive terms, home inspection with right to void only. Maybe you want to sell as is. It could be a number of other attractive terms. And you too end up going right around here, right at or right above market value. You take something that many want and you put it on sale, and you put it on sale just below. And because of that, you don't have this ceiling like you did over here, but you have now a little room to go for people to offer just above market value, especially when you produce a multiple offer situation. And so if you understand human psychology and you understand patterns of how things typically go, then what you are going to do is put yourself in a position of greater clarity, greater empowerment, and really you're going to put yourself in a position with proven psychological tendencies and ways in which the brain works, so that you can align yourself with how we've been designed to run and how we've been designed to think and designed to work, and how the market over decades and decades and decades and decades and keep going decades has worked so that you can get the very most upside that you possibly can. At the end of the day, this is a framework for making decisions. I would advise avoiding this and really think through method 3 and 4 so that you can optimize and get the very most value out of not just selling a home, but when you're looking to buy a home, you can use this same framework to see how somebody priced a property, and you can anticipate, see around corners to really see based off of proven patterns what's likely to happen next. So, if you want to be empowered and you want to have the most clear understanding of market value so that you can max upside and minimize downside as you sell or buy, this, my friends, is a very helpful framework to use so that you can understand what true market value range is. Hope this helps. And until next video, I'll see you then. Bye-bye.